Have you ever, wondered what really goes on behind the scenes when a big company gets its finances checked? You see the reports, sure, but who's actually signing off on the numbers?
Mhm.
And, like, how do we know they're being totally upfront?
It's a really fundamental question, actually, and it leads us straight to this document that's absolutely key for financial trust, but, well, most people never even see it.
Exactly. So today we're doing a deep dive into what we're kind of calling the secret handshake of financial trust.
Huh, like that.
It's the management representation letter. You could think of it as, I don't know, the ultimate pinky promise between a company's bosses and their auditors,
That's a good way to put it. It really is foundational, vital for the audit's credibility.
right? So our mission today is to unpack what this letter is, why it's so incredibly important, and what crucial info it holds. We want to make its significance really clear for you. Okay, so this secret handshake, let's start right at the beginning. What is a management representation letter, basically?
Okay. At its heart, it's a formal written statement. It comes from the company's management, and it goes to their independent auditor.
From management to the auditor. Got it.
Yeah, and here's a key little detail.
Yeah.
Usually the auditor actually drafts the text, based on the audit findings.
Oh, interesting.
But, and this is crucial, it's always printed on the client's letterhead, the company's own paper. And it has to be signed by the company's top brass.
So that makes it official. It's their statement.
Exactly. It becomes this formal, undeniable confirmation of what they've told the auditor.
So it's not just the auditor saying we checked. Management is actively putting their own word on the line in writing.
Precisely.
But, I mean, doesn't that feel a bit redundant? If the auditors are doing all this checking, why do they also need management to write it down? What's the point? Why can't they just trust what management says?
That's a really sharp question. And it gets right to why audits work the way they do. There are three main reasons these written reps are just non-negotiable. First, it's about confirming representations. You see, during an audit, management gives the auditors tons of information. Some of it's spoken, some might just be implied by the documents they provide.
Like, just through conversations and meetings.
Exactly. This letter takes all of that, all those verbal or implicit things, and cements them into a solid written record. It's like getting every promise, every assurance down on paper, no backsies later.
Okay, so it locks it in, making sure what was said maybe weeks ago is still what they stand by.
You got it. That's the second purpose. Documenting the continuing appropriateness of those statements. Management is confirming right up to the last minute of the audit, yes, what we told you is still accurate, it's still relevant. And finally, number three, it really helps reduce the possibility of misunderstanding. Audits are complex, right? Lots of technical stuff, judgment calls.
Right.
This letter helps clear up any potential gray areas, make sure everyone's on the same page about what was discussed and agreed upon. So, for you listening, understanding this is key. It's all about creating this clear, undeniable proof of what management asserted, and that's just critical for the audit's integrity.
That makes sense. It really tightens things up, closes off any wiggle room later about who said what, but this is like optional.
Yeah.
Could a company just say, nah, we're good, skip the letter?
Oh, absolutely not. No way. This letter is mandatory.
Wait,
Mandatory.
100%. The auditor has to get this letter to issue what's called an unmodified opinion, basically, a clean bill of health.
Okay.
If management digs in their heels and refuses to provide this letter, well, the auditor generally has two choices. Issue a disclaimer of opinion, which means they say we can't even form an opinion.
Wow, that sounds bad.
It is. Or they might even have to just walk away,
Ah,
withdraw from the engagement entirely. So it's not just some, bureaucratic checkbox. It's fundamental. It shifts accountability squarely onto management's shoulders. That's serious. A disclaimer or withdrawal. That tells you just how non-negotiable this thing really is.
okay, so it sounds like it's almost the final punctuation mark on the whole audit. When exactly does it happen?
It really is the final piece of evidential matter. It's obtained right at the very end of the fieldwork.
The very end.
Yep, just before the auditors finalize their report. And crucially, the letter must be dated the same date as the auditor's report.
The exact same day?
The exact same day. Now, there might be, rare times where they get verbal confirmation right before, but the signed letter has to be in hand before that audit report goes out the door, period.
Okay. And does it cover everything?
Yes, it covers all the financial statements and all the periods included in the audit report. Even if, say, the current CEO wasn't there for the whole time span being audited, they still sign for it all.
Gotcha. And who actually puts pen to paper? Who signs this thing? Is it just, like, Any manager?
No, no, it's
Okay.
very specific. It has to be signed by the members of management who have that overall responsibility for the company's finances and operations.
Okay. And critically, they have to be people who actually know what's in the letter, who understand the representations being made. Typically, you're talking about the chief executive officer, the CEO,
Right.
and the chief financial officer, the CFO.
The top dogs.
Usually, yes. Sometimes other officers might need to sign too, maybe the controller, depending on the company structure and what's being represented.
Okay. And what about materiality? Does it cover every tiny detail?
Good question. Generally, representations can be limited to things that are material, meaning big enough to potentially influence a reasonable person's decision based on the financial statements.
Yeah.
However, and this is important, some things are always required, regardless of materiality, like management confirming they've provided all the board meeting minutes, all the financial records the auditors asked for. That's non-negotiable material or not.
Okay, that makes sense. So we know it's mandatory, who signs it when, but let's get into the meat of it. This isn't just a generic "we did okay" note, right?
Mhm.
What specific things does management actually promise in this letter? What's in it?
Right. This is where we really see the commitments being made. It's pretty detailed. First up, the financial statements themselves.
Okay.
Management has to state point blank that they're responsible for making sure the financial statements are presented fairly, according to the rules like GAAP or IFRS.
So they own the numbers.
They own the numbers, and they also have to confirm they're responsible for having effective internal controls. Systems designed to prevent or catch material misstatements, whether those slip-ups are due to, error or outright fraud.
Wow, that's a huge promise right there. They're basically signing off on the accuracy of the whole picture, and the
Yeah.
system's meant to keep it accurate.
It is. It's a big one. Next, there's completeness of information.
Completeness.
Yeah, management confirms they've given the auditor everything relevant. They asked for all the info, all the access, and they confirm that all transactions that happen have actually been recorded and show up in the financial statements.
Okay, so no hiding stuff.
Basically, yeah, it's fundamental. The auditor can't do their job if they don't have the full picture.
Makes sense. And what about fraud? That always gets people's attention.
Absolutely. Fraud is a major, major section. Management has to acknowledge their responsibility for having controls in place to prevent and detect fraud.
Okay, their responsibility.
Yes. And they have to disclose the results of their own internal assessment of fraud risk. Did they look for risks? What did they find? Even more critically, they have to tell the auditor about any known fraud or even just suspected fraud that affects the company and involves management itself or employees in key control roles or anyone else if it could materially mess up the financials.
Known or suspected, that's broad.
It is. And get this, they also have to disclose any allegations of fraud, maybe from whistleblowers, former employees, analysts, regulators. If someone has made an allegation, they have to tell the auditor.
Wow. So they're not just saying we didn't find any fraud. They're saying we looked, here's what we know, here's what we suspect, and here's what other people are saying too. That feels much stronger.
It's a much more robust commitment, exactly. Okay, moving on. They also have to address laws and regulations.
Right. Staying legal.
Pretty much. They confirm they've disclosed any known instances or even suspected instances where the company hasn't complied with laws or regulations if that noncompliance could affect the financial statements.
Got it.
Then there's uncorrected misstatements. This is interesting. Sometimes during the audit, the auditor finds misstatements, but management decides, for whatever reason, maybe they think it's too small not to fix them. In the letter, management has to state that the effect of all those uncorrected mistakes added together and individually is immaterial, meaning they wouldn't change a reasonable person's decisions based on the financials.
Okay. And
That-
did he list those?
Yep. Usually a summary schedule of those uncorrected misstatements is attached right to the representation letter, so it's all documented.
So even if the little things seem small on their own, management's saying, we looked at them all and they still don't add up to anything significant.
Precisely. Okay, next up, litigation and claims.
Lawsuits and stuff.
Exactly. Management confirms that all known legal actions or potential claims that could affect the financials have been disclosed to the auditor and that they've been properly accounted for or disclosed in the statements themselves.
Makes sense.
Then there are estimates. Lots of things in accounting involve estimates, right? Like how long an asset will last or how much inventory is obsolete.
Sure. Lots of judgment calls.
Right. So management confirms that the methods they used, the key assumptions they made, and the data they relied on for these accounting estimates are, in their view, appropriate.
Okay. What about those tricky situations with related parties, like transactions between a parent company and its subsidiary or with executives?
Good question. That's covered too, under related party transactions. Management has to disclose the identity of all related parties,
All of them.
all of them, and confirm that all the relationships and any transactions between them have been properly accounted for and disclosed according to the accounting rules. Transparency is key there. And finally, there's subsequent events. These are significant things that happen after the balance sheet date, but before the auditor actually issues their report.
Like what?
Oh, maybe a huge fire destroys a factory, or they make a major acquisition or settle a big lawsuit. Things that happened after the period being audited, but before the audit is finished.
Right. Things investors would definitely want to know.
Exactly. Management has to confirm that any such events that require either adjusting the financial statements or disclosing in the notes have been adjusted or disclosed.
Okay. That seems like a pretty exhaustive list.
It is. And it doesn't even stop there sometimes. Auditors often ask for additional representations based on the specific company or industry,
Like,
maybe about how they adopted a complex new accounting standard, or confirming their assessment of whether certain assets have lost value, impairment, or confirming their plans if they're thinking about shutting down a part of the business. It gets tailored.
wow, that is far more comprehensive than just, the numbers look okay. It covers process, judgment, completeness, future events. But this raises a really important question. What happens if the auditor gets this letter, all signed, but something just feels off?
Yeah.
Maybe other evidence they found during audit seems to contradict what management is now putting in writing? Or maybe they just have doubts about management's, honesty.
That's a critical situation. If the auditor starts to feel that these written representations aren't reliable, maybe they have concerns about management's competence or their integrity, their ethics, their diligence, or if the letter just flat out contradicts other evidence the auditor found and they can't resolve it, they have to take that very seriously. It casts doubt on all the information management provided.
So what do they do?
If there's sufficient doubt about management's integrity, that's the key phrase, the auditor generally has no choice. They usually have to issue that disclaimer of opinion we talked about, saying, we can't rely on management, so we can't give an opinion. Or, again, they might have to withdraw from the engagement altogether.
So it really comes down to trust.
Absolutely. It underscores just how foundational management's trustworthiness is to the whole audit. You could almost see the rep letter as the auditor's final, gut check. If they can't trust that letter, the whole process breaks down.
It's not just a formality then, it's a real litmus test.
Yeah.
Okay, so that's the standard letter. Are there ever situations where even more is needed, like special cases that require extra promises in this letter?
Absolutely. There are definitely special cases that layer on additional requirements. Two big ones come to mind pretty quickly. First, when you're auditing ERISA plan financial statements, that's the Employee Retirement Income Security Act, basically.
Huh.
Audits of company retirement plans like 401k.
Okay. Important stuff.
Very. In those audits, management has to make extra representations. They need to confirm they've provided the auditor with the most current plan document, including all the amendments. They also have to explicitly acknowledge their responsibility for actually administering the plan correctly and keeping proper records for all the participants.
Makes sense. They're the ones running the plan.
Right. And if they choose a specific limited scope type of audit allowed under ERISA Section 103A3C, don't worry about the number. Management has to acknowledge their responsibility for making sure that type of audit is even allowed, that the bank or institution providing the investment info is qualified, and that the info itself is measured and presented correctly.
Okay, so very specific rules for retirement plans. What's the other big scenario you mentioned?
The other really common one is an integrated audit. This is typical for larger public companies. It means the auditor isn't just auditing the financial statements, but they're also auditing the effectiveness of the company's internal control over financial reporting. It's two audits in one, essentially.
Right, the Sarbanes-Oxley requirement for many companies.
Exactly. So in an integrated audit, management has to provide a whole slate of additional representations specifically about internal controls.
Like what?
Well, they have to acknowledge their responsibility for designing, implementing, and maintaining effective internal control over financial reporting. And crucially, they have to state that they've actually evaluated its effectiveness, usually as of the year-end date.
So they did their own assessment first.
Yes, and they have to affirm that they didn't just rely on the auditor's testing for their own conclusion about whether controls were effective.
They can't piggyback.
Nope. Management also has to confirm they've told the auditor about all significant deficiencies and material weaknesses they found in internal control. Those are specific levels of control problems.
Okay.
And they need to state if any weaknesses identified in prior years are still hanging around unresolved.
Mhm.
They also have to describe any fraud they found that either resulted in a material misstatement or involved senior management or other key employees in controls.
More fraud disclosure.
Yep. And finally, they have to state whether there were any significant changes to internal controls after the as of date of their assessment, but before the auditor's report date.
Wow. So a whole extra layer focused just on the control systems.
Exactly. And just like with the standard letter, if the auditor can't get these specific internal control representations, that's
Yeah.
considered a scope limitation. And again, it generally leads to a disclaimer of opinion on the effectiveness of internal control or withdrawal from the engagement.
So from confirming every little transaction detail to explicitly covering fraud risks and known problems to uncorrected errors and even diving deep into the specifics of retirement plans or the strength of internal controls.
Hmm.
This management representation letter really is, like you said, the bedrock of trust in an audit.
It truly is.
It's management, formally, putting all their assurances in writing, taking direct personal responsibility for the financial picture they're presenting.
That sums it up perfectly. It's that formal confirmation that really underpins the auditor's opinion and ultimately the public's ability to trust those financial statements.
So the next time you hear about a company's audit results, especially if they get that coveted clean opinion, maybe pause and consider what's actually standing behind that report. Are you confident that management has made every single one of these crucial promises, these representations, without hesitation, knowing how serious signing that letter really is? And, what does that ultimately mean for how you view the financial health and the integrity of the companies all around us?